Awesome. So I want to appreciate everybody for showing up today. I've got a lot of new information today. I'm actually pretty excited. I went to a webinar, and just so you know, I stole all this information from them. But I was really super impressed with it, and I hope that you folks all are. I'm going to talk pretty quick because we got a fair bit, and I want to be able to make sure that we have any time for any Q&A. So I am going to share my screen. And if you do have questions, feel free to pop them in the chat. And if I don't get them while I'm talking, because it's hard sometimes to share, chat, and do everything, we'll definitely make sure we do them by the end. And there'll be plenty of time at the end for you to unmute yourself and be able to ask your questions. So I am going to start can you see my screen? Thumbs up. Awesome. Thank you very much. Okay, so today we're going to talk about before 2026 hits, what's happened so far in 25 and leading up to 25. And then we're going to talk about a blueprint that any investor should be looking at for moving forward. So I'm going to go through here again. This is an educational series. I am not your financial planner. I am not your advisor. I am not your accountant, but I do the best to provide information that believe to be true and accurate. A little bit about myself. I started investing back in 2018, and I've been a limited partner in 20 syndications, a general partner sponsor. It's now getting up to 16 for a total of 36. I have put my contact info in the chat. I am always excited to be able to help people learn all about passive investing. So a little bit about Massive Capital. We're a vertically integrated real estate company, developer of Class 8 retail. We were talking about that. We're building one in Houston. We do have one here in Austin. We're an owner operator of Multifamily. We're very Texas focused, but we do have assets in North Carolina, Georgia, and Denver. Realty One, our partner, who is our partner in the development of the retail space, has about 300 million in assets, and Massive Capital has about 210 million in assets.
And now, here's someone you want to hear from, our sponsor.
For over 15 years, Skyline Title has been a trusted name in Texas real estate. From first-time homebuyers to seasoned investors, our team ensures a smooth, reliable closing experience every time. Backed by a decade of partnerships and proven success, we take pride in protecting your biggest investment, your home. Visit SkylineHTX.com to learn more.
So today we're going to talk quickly about what is a syndication and GP/LP, because this is all the basis of what we're talking about here. And talk a little bit about what happened in 25, and we've sort of got some leading up to 2025. We're going to talk about what type of investment should we look for. We're going to talk about the real estate's next cycle, the top 3 reasons why you should invest in 2026, and then obviously lots of time if we have it for Q&A at the end. So again, for those that are new and haven't been to my presentations, what we do is we do a syndication of our deals. So how it works is a group of real estate investors. We pool our money to buy or develop real estate. Syndications are a way for the average person to invest in larger properties they couldn't do on their own. And then for passive investors, syndications are totally passive. So how it works, sponsors, general partners. So if you remember from my first slide, I've been that on 16, where I have partnered with other people that are experienced real estate professionals, and we organize the syndication, we secure the funding, and we implement the business plan. The limited partners, we bring capital from limited partners to invest in our opportunities, and they help us fund the project, and they actually own a portion of the asset. So I'm going to give you a fairly simplistic view of what happens here. Let's say we're going to buy a $10 million property, and we're going to get a 70% loan to value loan. So we would get a $7 million loan. This means that we need to raise $3 million. And again, this is very simplistic. On a $10 million deal, we'd probably be raising closer to $5 million just because we need to raise enough money for some of the other things we're doing. But The beauty of this is the passive investors are putting up the least amount of capital, but actually own 70% of the real estate asset. So again, the benefits are limited liability. You have no risk other than the money you invested. You can lose the money you invested, so I want to make sure I'm clear on that. It also allows you to target investments to be able to invest in different asset classes, different groups, different geographic areas. So I've been invested in value add multifamily, new build multifamily, lots of different things. I'm involved in a medical center, new build storage, and I'm in several states for different things. So again, it allows you to help get some diversification. And again, the returns are directly tied to the success of the project. And we'll talk a little bit about how that works as we move forward. So there are some rules for syndications. There is two basic general areas that you can raise capital from investors. Number one is a 506B syndication. As a 506B syndication, we must have a pre-existing relationship and you must be considered a sophisticated investor. Part of the reason for these trainings is to help you become a sophisticated investor. Also, there are only 35 spots, and we offer it to our community, a massive capital community, before we offer it to anyone else. And it's a first come, first serve basis. So again, if I'm raising $3 million and 35 people put in 100,000, somebody's going to miss out. And again, some of our offerings are much larger. So you want to make sure that you get on. But the most important thing that you have to follow on the rule is no general solicitation. So I actually often have a 506B, but I can't talk about it on this call because I don't have an established relationship with everybody who shows up. Plus, these calls are uploaded on YouTube on a public channel, so that would break the securities rules. And also, I should be clear too that non-accredited and accredited investors can invest during the 506B period. And then we switch our offerings. Now, some groups only offer 506C, and 506C opportunities only accredited investors can invest. And an accredited investor is someone who has assets of $1 million, excluding your home, or personal income of 200,000, family income of 300,000. And then for me, there are no restrictions on soliciting. So I can talk about it. I can post it on my Facebook group. I can post it on my LinkedIn. I can do anything I want when it's a 506C, but only accredited investors can invest. Now, the most important thing for you to know is there's actually no difference in the offering, only who can invest and can I market. So it's actually all of the same terms and conditions that apply. So it's a great way for people to be able to invest in opportunities. So again, if you're interested and you're not accredited, just get on my list. Let's have a call. Let's get to know each other. And all I'll do is notify you before a deal comes. It says, hey, I have an opportunity. Would you like to learn more about it? And you can come and learn more about it, then make a decision if it's an investment that you want to do. So again, make sure that we're connected and that I know you're looking for them, because what we do is when I have a new deal, I have a whole database where I say waiting for, and we just contact you first. So again, if you don't find a way to make money while you sleep, you will work until you die. I'm going to go through this one quickly. We do this every week, but it's my favorite slide. Passive investing in commercial real estate is not a get rich quick. It is a get richer slow. So again, our goal is to double your money every 5 years. And I've taken tax consequences out of this just to make it simplistic, because everybody has different tax scenarios. But if you invested $100,000 and we doubled it and it grew to $200,000, to be able to compound your money, you want to take your original 100 and the 100 you made, and you want to invest that 200 and turn it to 400. Then you want to take your original 100 and the 300 you made, and you want to invest it and double it and turn it to 800. Again, you want to take the original 100 and the 700 you made, that's 800, and you double it, it gets to be 1.6 million. You take the original 100 and the 1.5 million you made and you invest it again, it becomes 3.2 million. Now, I do understand this is a very oversimplistic view, but it is a super powerful view. This is what you really need to understand. You need to understand the power of putting your money to work. And remember, all of this money was made with someone else doing all of the work. Yes, you risk your initial capital, you do risk some capital, but again, you're not having to do anything. Someone else is doing everything. And yes, you will have some taxes unless you were smarter than me and you converted this first $100,000 to a Roth IRA. And if you converted it to a Roth IRA, you would actually grow over $3 million tax free. It's a lot of words. Oops, sorry, I touched my computer. Sorry, I got a loose wire here. When I touched my desk, my speaker shut off. So hopefully you guys got that. So we're going to talk a little bit about 25 and 26. There's a lot of information on these slides, so I'm not going to read it all, but I'm going to go really quick. So basically, all of our problems started in 2021. And what happened? And there was a race for a yield in low rate environment, right? Interest rates were at a historical low. And it ended up for a huge demand for syndicated loans and commercial real estate syndication deals. However, many real estate syndications utilized very aggressive strategies involving high loan to value ratios, short-term loans with floating rate debt called bridge debt, and often with a plan to refinance quickly once the property increases in value. I know personally, I'm on a couple of these deals and they got very distressed. So what happened was you bought them with what's called a bridge loan. And a bridge loan basically takes you from an unstable asset to a stable asset with a goal to be able to refinance it with very favorable terms. But again, the problem with that is many of those loans were at an 80% leverage and they were at 3, 4, 5% interest rate. Well, when they couldn't stabilize the assets and interest rates went up to 7, 8%, a lot of properties became distressed and were in risk of foreclosure or were foreclosed upon, right? So we all know, and I've got a chart here that talks about the bank rates going up. We all understand. And then to add, to kind of compound what happened was as the whole market started to accelerate, and I have a really good slide on this one too, people started building all kinds of multifamily deals. And there became a huge oversupply. And again, you'll see when I'm projecting, talking about moving forward, this is correcting itself. And some areas such as Austin, Dallas, Miami, Tampa, they're kind of the top four. I live in Austin, and Austin is crazy. We had so much supply that a lot of places are just really struggling to be able to keep their occupancy rates up. And then again, what happened was, right, we had this area of rapid inflation, a lot of things happening. People were used to getting 10, 12% rent bumps, and then all of a sudden rent started flattening. But to make it even worse, what happened was people had to offer concessions to be able to get people into their apartments. I got a friend, and he is like way more experienced than I am, owns about $3 billion worth of real estate. And I went to an event where he was speaking, and he said, never in my plan, he was building Class A apartments in Austin, Texas. Never in my plan was it to have 2 months rent concessions to get people to move into my apartments. It was never in my plan. Big, big struggle, right? So all of this influx of supply really messed up the demand. And then you add to it the fact that rents were flattened or went down through concessions to attract tenants. So again, the biggest statement for this period of time is nobody knew who was swimming naked until the tide went out. And so the tide went out, and all of a sudden, and this is a great statement from Warren Buffett, everybody realized that, hey, we're all swimming naked. We don't have the protection. We don't have what we think we were going to have, right? And so, yes, there was a lot of distress, and you've seen I put this slide up before, Baron Rothschild. When there's blood in this, buy when there's blood in the streets, even if it's some of your own blood. And again, one of the biggest things that I believe is coming, and you'll see some of the statistics I'm going to give you, that we are about to go into one of the biggest reset and one of the biggest opportunities to be able to take advantage of what's happened. So I'm going to quickly talk about one deal that we still have available. It's actually closing Friday. And we have enough money to close, but we still have a few spots open. This is our Woodland Ridge in North Carolina. A couple of you folks on the call have invested with me, so thanks for that. This one comes with a 7% preferred return. What that means is until you make 7% on your money, us as sponsors don't make anything. This one estimates a 2x multiplier, and it's a 18% IRR, which is their internal rate of return. And this is a 506C for accredited investors only. This gives you a little bit of idea what happens, right? So again, a 7% preferred return, 18. It is actually works out to about a 7% cash on cash, 2x multiplier, and it's a 70-30 split. So sort of showing you what happens if you put 100,000 into the deal, make about 5,500, 6,500, 75, 7,500. So you'll make about $35,000. Assuming we hit the sale price, which we feel pretty confident we're going to, you'll make another 70,000 there, and you would take your 100,000 and you would turn it to $205,000. So again, one of the things that's interesting to note on this deal, we're really not catching up to where us as general partners are making any money till year 4 or 5, and we want to do better than that, but we don't feel comfortable enough to predict better than that. Now, if you don't know anything about bonus depreciation, thanks to the big, beautiful bill, bonus depreciation came back to 100%. How you can use it depends on who you are and what your situation is. So again, for example, if you invested $100,000 in this particular opportunity, you're going to get a year one passive K1 loss of about $63,000. Now, if you're a W-2 person, passive losses only go against passive real estate income. If you're a real estate professional like myself, passive losses go against my entire income. But again, one of the things, no matter who can use it or not use it, it's not a use it or lose it. So it will stay as a passive loss. So once you start earning these numbers, they will actually come to you tax-free because you'll have a passive loss. Now, there is recapture. I don't want to get into an accounting class, but if you keep your money moving, you should never be afraid of recapture. So these are David and Leonard. They're our partners. It's actually our second deal that we've done with them. Our first deal that we did with them is Westwood Villas in Midland, Texas. And again, when we talk about projections and reality, and I want to make sure I'm clear here, past performance doesn't guarantee future performance, but I want to tell you what great operators, and we're excited to be partners with them. They projected they would make about 817 in revenue. They actually made 882, 8% increase. They projected they would spend about $402,000. They spent 373, 7% less. This combined, anybody who knows anything about commercial real estate, NOI is king, your net operating income. They projected they would do about 414,000. They actually did 509, right? So earn more, spend less, you make more, right? Simple as that. And they had projected in their original plan that they would pay out about 5% on the return, 160,000. And because of their great work that they've done, they actually were able to pay out 7%. So this is a deal, and it started cash flowing and paying. And again, past performance doesn't make for future, but these guys are pretty good operators. So this is something I want to show you that blew my mind. I've shown this chart before and I finally got one. And by the way, all of these came from Marcus and Millichap, one of the biggest brokerage places in America. And so this is a super important slide for you to look at. So this is rents starting in 2011. This is what people on average, now this is America wide. So this isn't city specific, anything specific. So rents went along like this, right? And then we all know rents started to go up in 21, 22, 23, 24, 25, right? So it went from you were paying about $1,000 here to average of 1880. Well, check this out. This is based on the median household, the median house price cost, and the current high interest rates. This is what happened to people that are paying mortgages. Check this out. This is staggering. This is a $1,186 a month delta between what you would be paying as a renter in an apartment or you would be paying in a home. This is staggering, absolutely staggering. Now, even more staggering. This slide, I've never seen this before, and it blew my mind. So for the last 10 years, 48% of Americans pre-qualified for a mortgage. It's now 28%. So just think about this. That now means that more than 70% of America will not qualify to buy a home. That is mind-boggling. In fact, it's somewhat scary, but it's really good news for those of us in the multifamily space. I don't want to make light of the fact that this dream of owning a home is basically, out of reach for most people. But if you look at that, half of America used to normally be able to buy a home, right? And we all know it. I've known people that have been lifelong renters their whole lives. That's just what it is. They just not going to get there. So now you're not only are you priced out, you no longer even qualify. So this is another one that's just blew my mind when I saw it. So this one here, back in 2010, the average first-time home buyer was 30. And in 10 years, it went up 3 years. In 2 years, it went up another 3 years. In 3 years, it went up 4 years. So again, combine this with some of the other statistics that the average person buying a home right now, and again, you gotta remember the very low, right? Only 28% of people are qualifying, and they're 40 years old. So again, when we're looking at thinking, is multifamily something that is appealing to me? These things here are some of the most powerful statistics, right? That you people are just not getting into homes at an earlier price. And then again, this is the national vacancy rate. So way back here, we had a lot of vacancy. And then you can see here, there was a lot of new supply put in the marketplace, right? So this is new apartments that were completed. So you can see, right, as soon as you got all these units, we absorbed a big chunk of them and it's starting to come way down. And right now, the average national vacancy is 4.7. Now, I'm going to tell you again, national average, pretty big spectrum, right? If you're in Austin right now, the average vacancy is closer to 11%. Okay, because Austin got way overbuilt. There are other markets, the market in North Carolina, they are running at about on average about 5%, which is really good. So it's able because again they've got no supply coming. So again, this is really fascinating. Okay, and so in short, when you're looking and thinking about it, you want to look for stable markets, both in population and rate. Stable, not aggressive like we saw before. You want to look for deals with fixed rate debt at a reasonable loan to value, right? So 65, 70%, not at the 80%. Again, that's what happened. That's how those people all of a sudden became swimming naked. Now, luckily at Massive Capital, we've never done any bridge debt, so we're very happy of it. Obviously, when you're thinking about investing, you want to make sure that if you can, you're getting as much of the tax benefits. It's not how much you make, it's how much you keep, so that you're taking advantage of it. The fact that it's 100% now, you're going to get it. You're looking for experienced operators who are focused on risk and deal structuring, targeted markets with better supply and demand. And then this distress has created one of the biggest buying opportunities, and it's the best time to buy real estate when there's blood in the streets. So again, it hasn't completely reset yet, but it's resetting. So the deal again, I don't want to talk too much about the deal we bought in North Carolina. That one was for sale for about $8 million. It went down to 7, 8. We spent a year and we finally bought it at 7 million at a good basis, at enough of a basis. So again, you want to make sure that you're looking for deals in stable markets. That market only has 78 new apartments coming online. So again, I know I say this a lot, but don't wait to buy real estate and wait. It's a time to hang on. You still have time to be able to get it. So we're going to talk a lot here about the real estate's next cycle is on us. Okay. So again, pricing has clearly reset. I mentioned that before. So after a long expansion, commercial real estate has undergone a broad repricing, right? Unparalleled values in multi-index are down about 19% from their peak of 2022, and the values are ending up about 25% down. Now, for those of us that bought back here in 21, 22, some of our blood is in the streets, I'm sorry to say. And I'm going to be honest, I've got some other passive investments, and they're really hurting. And again, 2025 shows U.S. commercial properties are still well below peak levels, even after posting a 4.2% gain over year, the strongest annual increase in 3 years. And again, I'm not going to go through all of this, but historical cycles that always follow a 15 to 25% real price set have produced some of the best forward returns when capital steps in early. So again, a large outdated. We talked about this before, right? From 2004 to 26, there is still coming a wall of maturities, and they're going to be more focused in 26. Late November data projects there's about $936 billion of commercial mortgages renewing next year. So again, it's going to be a reset. If your mortgage renews and if your property is not cash flow, you're going to have to be able to refinance it, and they're going to reassess it, they're going to reappraise it. And again, in 2029, there's over $1 trillion. So again, I know these are a lot of big numbers, but most owners that are near maturity are looking for extensions. So again, my loan is coming due. I want to have an extension. Sometimes on extension, they're making you put some more capital down. Used to be in the heyday, 21, 22, you could do what was sort of called a cash out refi. They're just not letting that happen. They're making you put up some more reserves. And then I mostly talk about multifamily, but office space is very, very much a distressed asset class right now. So again, the bid ask is narrowing, right? For roughly 2 years, sellers anchored under old values while buyers underwrote too much of high financing costs, and that gap is now closing. So again, real estate transactions in October of 25 are up about 17% over a year in Q3 of 25, particularly in strong momentum of the multifamily. Late September, the market velocity narrowing between the bid and the ask spread, right? Again, it took a while. So that property was 7.8 million. We bought it for 7 million. It's going to happen. Prices are getting closer to the reality of what they're going to do. Now, this is another very alarming slide. This is transaction happening. So if you remember, we talked about a lot of folks got on the bandwagon here. So on average, this is normal transaction of people buying apartments. So again, a lot of people bought here, little less here, little more here. We're still down 18% from the average, but we're coming back up to be where people are starting to buy again and be able to buy some of those deals that we were talking about that have been readjusted on the price. So again, capital is not leaving commercial real estate, but it is waiting for discipline, right? So capital, some people say that, nobody will give you a loan, you can't get it. It's not true. There is a lot of money that is waiting to be deployed, but it's waiting for operators that are stable, that are buying under good value, that are buying with fixed debt, that have realistic projections. Again, the days of 8, 9, 10, 12% rent bumps are gone. You're still going to be able to get 3, 4, 5, maybe 6 in some markets to be able to do it, right? So the capital's not gone, it's simply more selective, and it's gravitating towards more experienced operators with clean, conservative underwriting. So the new supply, remember we talked about the new supply, it's being choked off in key sectors, right? So again, several segments of the combination of higher financing costs and lender caution has sharply limited new construction, even as demand stabilizes. New office construction, it's at a complete record low. It's still one of the biggest areas of blood in the streets for sure. And at some point, I still think there'll be something coming back. Multifamily is a large wave of competitors, but several in October, November from RealPage and other points, new starts are thinning the pipeline, particularly more constrained markets as demand. Today, buyers are not just buying a price reset, they're buying into the future environment where competition will be limited in many locations. So again, this is another mind-boggling chart. So this is new multifamily starts. And this chart on the side is apartment units under construction. So again, if you look at the trends here, you can see here, this was the big area where everybody was going crazy, right? So they'd already started. And one of the things you got to remember, multifamily starts, it's not like, okay, today's December, I'm going to go start a deal in March of next year. These are like a couple of years in planning, financing, building, and doing. So again, we have dropped 76%, and apartments under construction have dropped 53%. So again, when we're looking forward, this huge drop, and again, this drop brings us back kind of in parallel to way back here. This drop brings us back like decades. But what this means is that we're going to run out of apartments again. There is going to be a shortage of apartments again. We all know there's a shortage of apartments. It's just kind of mixed up between the cities and different things. But again, if anybody starts now in 25, those apartments aren't coming online till 28, 29, because by the time they build them, get them financed and different things. And right now, so again, this is a huge reset. This is a big thing that gives me hope that we're at a great spot in the cycle to where, okay, this is going to be a really big reset. So again, inflation has fallen. It depends who you listen to, how much it's fallen, right? Everybody's got a different number, but it does reflect that we're roughly around 3% to be able to do it. We have a lot of things with a lot of pressure on the feds to cut. Be interesting. I think the meeting's tomorrow or the next day to see what happens. And they've already kind of priced it in. So again, this is where we're at now, and they're forecasting it to come down to about here. So again, this is the 10-year treasury, which is very linked to what happens. There are definitely some bizarre gaps, like where we were way down. This is the Fed rate, and then the Fed change. These dots all represent when the Fed changed rates. So again, who in the world thought that rates would go up, 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 up? Look at the huge delta there, up, 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 up. That's a lot of ups, right? And then we waited a long time. We stayed stable. And then we got 3 downs. We got another 2 downs here. And then they're still predicting that there's going to be 1 more down before the end of the year. Now, I don't have a crystal ball. I wish I did. Then I would know the answer to what everything is going on. So it's very, very interesting. So this is cap rates. So cap rates have a lot to do with the prices of apartments, right? The lower the cap rate, the more money that things are worth, right, to be able to do it. So this is cap rates as they've gone through. So this is the average price of apartments, and this is the cap rate. So again, we can see that they're still just on a very slow trajectory. Average cap rate across America is about 6%. So I've got another chart that shows it for all the different markets. So again, the best distressed deals are at the operator level. It's very much at the operator level, right? So where the cycle actually sits. So a lot of people took on too much leverage. They underestimated capex and leasing risk. They had the lack of capital to refinance at the different rates. And this combination provides a great news for us that are ready to be able to do what we're going to do. So again, the buyer field is thin, more disciplined capital. You got to make sure that you're going in, right? So disciplined players, and I'm not going to read through all of these. Anybody who wants this can watch the replay, or I'm happy to share it. So we're looking for better entry prices, more dialogue with lenders, cleaner covenants and structures, more access to off-market or lightly marketed opportunities. I would say that most of the deals we're looking at are off what they call off market. So let me just quickly explain what off market means. Off market means that a seller has an opportunity, but he doesn't send it to everybody. He sends it to buyers that he think can close a deal, right? At the end of the day, brokers are responsible to close deals. So what a typical broker will do is they'll say, hey, Charles, Donna, you guys are in my buy box. I got this great deal. I think you should look at it. Now, once both of them pass on it, and there's more than both of them, right? There's still hundreds, maybe hundreds of people that are sent an off-market deal. But again, they're only sending it to the people that they think can close. And this is one thing that's happened with the volume that we've been doing at Massive Capital. We're looking, and I did a presentation last couple of months ago. We're underwriting, we're looking at about 100 deals a week. And deals are being underwritten. Some of them back a napkin, and we go down, and then we're still making about 10 offers a week, if you can imagine. Now, a lot of it is just throwing spaghetti at the wall and see what sticks, because you just never know. We're getting a lot of phone calls to look at distressed markets. We're getting a lot of what's called a pre-foreclosure. We have not been able to buy a pre-foreclosure. We've tried on several. It requires a little bit more horsepower than we have, right? So again, I'm not going to read through all these. It's kind of boring. So again, across all property types, there's mounting evidence that conditions are stabilizing. In some cases are already improving, right? The multifamily market has showed clear signs of stabilization in Q3 25, with supply imbalance evening, rent growth tracking pre-pandemic norms. So again, pre-pandemic norms, I want to make sure that I'm getting pre-pandemic norms, right? So rents were going up on average 3, 4, 5, 6%. Pandemic 7, 8, 9, 10, 11, 12. And we're getting back to the 3, 4, 5, 6. Okay. So I want to make sure that, again, if you see somebody coming along saying, oh, we can do this or do that, be very nervous, right? You want to make sure that you're doing this. So this is an interesting chart here. This is nationwide. This is put out by Marcus and Millichap, so I want to make sure I give them due. This is multifamily vacancies by city. And I'm not going to lie, I was surprised at some of these things, right? So obviously in the Texas market, where I'm very active, it is greater than 5.5%. I was very surprised in some markets, like in San Francisco and Los Angeles. Their occupancies are still super decent, right? Salt Lake City, of all of these states up here where I have never ever even considered investing, are really doing quite well. It's quite an interesting chart to be able to look at this. And again, for those that follow cap rates, these are the cap rates, right? So the US average is 6%, and you can see so the green markets are less than 5, light green 5 to 5.5, and then red is greater than 7.5. It's not a lot of red on this particular chart, but definitely something that happens. And again, this is the 10-year treasury, and this is the long-term cap rates average. And again, right now we're sitting at about, so back here, down here, we were treasuries down here. And again, you can see the cap rates they came way down in here, and now they're going back up. So again, the lower the cap rate, the more expensive a property is, right? So you want to buy with a high and sell with a low. What happened is everybody was buying with a low in 21, 22 and selling with a high now. And so that's what's gotten rid of a lot of the value in properties. The 3 reasons why I think you should invest in 2026. You're going to get a full year of passive income, right? Remember, I talked about the time use of money. So again, get your money moving as quickly as possible and keep it moving, and you're going to get that whole benefication. You can start off, you may have no money right now, but you want to make sure that you're deploying your capital early, and so that you can do some tax planning based on getting any of the bonus depreciation, any of the benefits. There's always lots of tax benefits to be able to do it. And you want to make sure that you get to deals. And again, this is more for us as sponsor. You want to make sure that you get to the deals before somebody else does, right? So getting in early, which is what we're doing. We're really ramping up, getting ready to go, will give us access to better opportunities before the demand rises. So again, I went through this pretty quick. You're one decision away from a new life. Take massive action. Massive dreams need massive action. So this is Mike Shirar, Sanjay. For those of you that don't know, Sanjay's who I made my first passive investment with 7 years ago. He was my first coach for what I was doing with multifamily investing, and still a great friend and partner. And again, I'm going to get one more time where I'm going to share my contact info. My goal is to help 100,000 people reach financial independence through real estate investing. I hope you found this presentation helpful. I'm going to stop sharing and see if I missed anything in the chat. Just to think a few folks introducing themselves. Awesome. Very good. Now, anybody got any questions? That was a lot. And anybody want to see a slide again?
Great presentation, Trevor.
No, good
Love
to see
all
you,
the
David. I even said nice things about you, and I didn't know you were here. I can't see the audience when I'm presenting.
when the
So
wise
David
one
is
is
our partner in the deal in North Carolina, and he's been a great partner. I think we talk every day now.
I love sitting in on your presentations. When the wise one speaks, you got to be quiet and listen, man.
Yeah,
I missed the cap rate slide. I wanted to see if you can hop back to that real
I
quick. I
can
just wanted to
for
take a
sure.
quick
Let me
look at
get
that.
there.
A lot
Yeah, it
of
was.
great
I tell you what,
uh
it was a gold mine being able to join that Marcus and Millichap presentation. Those guys, they put out some really good information. If you ever get on their list, so here's the cap rates here, right? So you can see Charlotte, Raleigh, between 5 to 5.5%.
I love it. And you said we'll be able to find this presentation somewhere?
Yeah, well, it will get rebroadcast, but I'm happy to send these to you as well.
Okay, great.
Yeah, thanks for being here. I didn't even know you were here, so I can't see who's here. Once I start sharing, you guys disappear, and it's uh, it's one of the things.
Great job. Thank you. Glad to be here.
Thank you. Glad you could be here.
Trevor, can you show the vacancy rate slide as well?
Yeah,
Thanks.
yeah, my pleasure. Yeah, these were great slides. It was like hitting the gold, and there's a bunch more. I took like 10 out so that this wasn't just slidey. So this is and again, the US average is 4.7. And I'm going to be honest, like they're showing Austin here is greater than 5.5. I know Austin is like closer to 10. Austin is still recovering. They look at Austin as kind of the bigger area. And so, I have some apartments in Round Rock, which is a suburb of Austin, and we're about 92% occupied, which is still less than that. So yeah, it's pretty mind-boggling. And again, the one that blew me away the most was the fact that so many people now are going to be lifelong. Like I knew there was a lot of stress, but so many people are going to be lifelong renters. I've been saying it for a while, but I never had a slide that went past, 22. And then I saw this one and I was like, oh, I mean, that's insane. And the fact that 70% of Americans no longer qualify for a mortgage.
Hey, Trevor.
Hey, Jeff.
It's Jeff. How are you?
I'm
So
doing awesome.
the relationship with home ownership and apartment there's commonality between the two. Should we be concerned that as mortgage rates come down, home ownership becomes more affordable, that won't bring down apartment rates?
So I think it's the combination of this gap being so large and then the supply side now getting cut like by 75%, right? So I think those two, and again, I'm not an economist. I just stayed at a Holiday Inn and watched a webinar. But I think what's going to happen is there's going to be a little bit of balance, right? So you got to look at all of the levers, right? So definitely mortgage rates coming down are going to help people for sure. And it's going to help them. But I'll be honest, what I think it's going to help more is the people that want to get out of their existing home, right? And buy something else. They're trapped in, right? Anybody who's trapped in at such a low rate can't get out.
Right. But the bottom line is that housing affordability is going to go down.
Yes.
Politically, it's got to. And so if you as a consumer, you've got two choices basically. You can rent an apartment or you can rent a house, you can buy a house. But if the price of housing goes down, you're going to be more attracted to that. There's going to be movement from apartment people to housing.
Oh, no doubt about it. There'll definitely be. It's just, I think there's so much there's more movement the other direction. And it's going to change just people's lifestyles.
Okay.
Yeah. I mean, that's my thinking. Again, I'm not an economist though. So
No worries. Thanks.
yeah, no, it's a good question though. Anybody else have a thought? Happy to have someone else. This is a place to learn. No, awesome. I'll do some research and maybe I'll make it one of our presentations early in the spring.
That's always been a big, I guess, concern of multifamily investors is whether the shift's going to happen. And I just see a lot of the younger generation, they just don't want that responsibility. It's easier for them to rent, cheaper for them to rent. You don't have property taxes, you don't have all that other stuff. But families, yeah, I probably see them going more towards purchasing the single family when it becomes more affordable. But everybody's going to need a place to live. Everybody's having babies and population's growing. So that's going to be interesting to see in the next 5 to 10 years how that shifts.
Yeah, I'm trying to see if I have another, because I took a bunch of slides out, but I moved them all somewhere else. If there was one that might talk about but that's a great one. I'll look into it and try to put it in a presentation moving forward.
Yeah, and Trevor, when you're doing that, I'm trying to recall exactly, and I won't be exact about that, but if you look at the total homes in America,
Yeah.
only about 60% are primary occupant. The homeowner is living in their own house. The other 40%, 8% of it's vacant. But you've got Airbnb, you've got people with second homes and third homes. So there's a lot of homeowner inventory out there that's eventually going to move one way or the other. I couldn't tell you what that's going to be, but that's part of the reasons we have a housing shortage. Is because they've been going to other uses rather than the homeowners.
Yeah.
Abode.
Yeah, and it was interesting. I was actually at a webinar or at a in-person event today, and they were talking. They were more focused on the housing market than the multifamily market. You know, it was a very small part of it. But there was a guy there, and he's a national buyer of distressed debt, and he said in the last 6 months that 80% of his distressed debt was Airbnb because they just no longer were able to function. And of course they bought an Airbnb, assuming they're going to get, $200 a night, not $80 a night, which is a long-term rental or whatever, $50. And he said that 80% of his new distressed inventory for the first time ever was all Airbnbs.
That's good information. Thank you.
Yeah. And he said, I've never seen it before. Go ahead, Wilson. You're on mute.
Good morning, everyone. My name is Wilson from Nigeria. I'm into building material. It's 2 a.m. in the morning here in Nigeria. So, please, what I have to say is just a presentation of the company that I want to build. It's not a question that comes directly from the program we have this evening. So, I have a mindset to build one and only biggest company in the whole world that can provide everything that concerns building materials all in one place as stable and generous. I spent 18 years to learn everything that concerns building material. And what makes me to learn everything that concerns building material is I found out there is not a place in the world that you will see a company that can provide everything that concerns building material all in one place as depot and channels. So it gives me ability to go extra mile to run everything that concerns building material. Now, all the contacts that I need to build this company as depot and channel here in Nigeria and all the companies that manufacture building material all over the whole world. I have their contacts. Everything about this company is ready. The only thing I'm looking for now is investors. I need a deal.
Do you have a question?
Yeah. What I need now is that I need $300 million to build this company here
Yes.
in Nigeria.
So this is not a place for you to raise capital to build your company. Sorry, sir.
You're welcome. That's no problem.
Yeah.
Thank you.
Yeah. Thank you. I think I get emails from them. I'm only kidding. He sends me a note every day. I connected with him on LinkedIn, and yeah. So awesome.
I'm with you. I'm with you on LinkedIn. I always
Yeah.
reply your message on LinkedIn time to time.
Yeah. Awesome. Any
Thank
other
you.
questions from anybody?
Just wanted to say thank you, Trevor.
I'm glad you made it.
Yeah, I took a lot of picture. There's really good information sources like vacancy rate and cap rate by state. So I love it and I really appreciate it. Thank you so much today.
No, thank you. And I enjoy doing these. I was glad to get a great turnout. I appreciate everybody that comes. Again, it's the second Tuesday of every month. We're trying to ramp it up and get some more folks. Some of you probably got a phone call from Marilyn. We went on a mission to try to get some more because the attendance was waning off a little bit. So part of it was I wanted to get some new content and end the year strong. So I hope everybody has a amazing holiday season and that's just filled full of your friends and your family. And David's going to have a great, he's going to be closing his second apartment complex. A very exciting thing to do. And also he's going to have a child first time for Christmas. He just
Yeah,
had
it's
a
what a
little
blessing.
baby. Yeah, you got good friends and partners when they send you a picture from the hospital of a few. Yeah,
Almost 2 months old. Well, 7 weeks on Saturday.
yeah,
Almost 2 months.
that's awesome.
Yeah.
Yeah, nothing beats those family memories.
Yeah, that's a really huge gift. Congratulations.
Thank you.
Awesome.
Thank you.
All right, well, thanks everybody for joining. You all have a great holiday, and I really appreciate everybody showing up. Thank you.
Thank you.
Take care.